Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, this is Vijay Bambani. I hope my videos are helping you decipher the message of the markets better and it's helping you to garner higher investments and trading profits. In this video, I want to talk about the Indian IT or the information technology sector. It's been a little weak of late, and that's putting it mildly. And we want to see whether it is weakness inherently of these stocks within the sector or is the weakness coming in from outside. It's a little like inflation actually. Is inflation rising because of domestic factors or is it imported inflation? What is imported inflation? When the dollar becomes too strong versus the rupee or oil and gas prices jump too high. When you import these commodities, oil and gas results in transportation, etc. going up and it has a trickle-down effect. So inflation is of two types, imported and domestic, and the sectoral weakness in the IT is also to be seen in the light of what's happening in the overseas markets as well. So on your screen right now is the chart of the Nasdaq. The Nasdaq is the index of the IT space, technology space. As you can see, there is a death cross on the Nasdaq, and the death cross was made on 3rd of March 2022. What is the death cross? The death cross is when the 50-day moving average, which is a proxy for medium-term average holding on cost of a delivery-based buyer, falls below the 200-day moving average, which is a proxy for the long-term holding on cost of an average buy and hold investor. What it basically says is that the price is headed lower and in a waterfall fashion, the averages are cutting down way. The opposite of that is the golden cross, when the 50-day moving average cuts the 200-day moving average upwards. But this is downwards, so it is called the death cross. As the name itself suggests, the implications are bearish. And whether we like it or not, Indian markets can never be 100% decoupled from the overseas markets. Now, what are the dynamics of the Nasdaq falling leading to the fall in the Indian IT space? You see, the biggest investing is done by the big boys of the stock markets, which is the mutual funds, the hedge funds, and the pension funds. Call them collectively as institutional investors. Now, when the Nasdaq has fallen, they will resort to cutting allocation to technology stocks. It's not just the FANG stocks, Facebook, Apple, Amazon, etc., right? Netflix, Google, these are FANG stocks. They won't just cut allocation to the FANG stocks. They will also sell the ADR, GDR of Infosys because it is a sectoral cut of allocation to technology space. When the ADR, GDR of Infosys falls overnight on the Nasdaq, next morning, there is a psychological pressure on a bull on the NSE and therefore you see the prices of Infosys falling even on the NSE itself. Make no mistakes about this. The Nasdaq making a death cross has definitely had a bearing on the weakness in the Indian IT space. Now, where is the CNX IT index? Let's take it and see whether we are under any threat of a death cross as we speak. On your screen now is the CNX IT index, a daily time frame compression, and the 50-day moving average is still marginally above its 200-day moving average, which means we have not yet reached the death cross stage, but there is no denying the fact that prices are lower and the 50-day moving average is in a downward spiral and threatens to cross the 200-day moving average downwards. Will it or will it not? Will the prices bounce back? That, of course, mother market knows best. But I would say if I was to be asked rather, what is leading the Indian tech stocks down, I would say the death cross of the Nasdaq is one of the primary reasons which has triggered reduced allocation to the IT space by the institutional players and all the alpha funds. Alpha funds are momentum funds. They raise allocation to that sector which is rising and they cut allocation to that sector which is falling. They are dynamic funds, and alpha funds, I can assure you, are selling IT stocks, which is again leading the price to head lower. So whether we like it or not, we are not decoupled from the foreign markets, and the Nasdaq has definitely made an impact. Does it mean that you should sell IT stocks from your core portfolio which you bought with a view of 5, 10 or 20 years? No. These are passing moments on the blip of a long-term investor. Do remember my previous video about the Kopach oscillator as to how to invest in a bear market and how pessimism hits a rock bottom, and then after 10 to 14 periods, if it's a short-term pessimism, 10 to 14 days, medium-term pessimism, 10 to 14 weeks, and if it is a long-term bear market, 10 to 14 months. Kopach's oscillator has taught us that between 10 to 14 periods, markets find the bottom and start rallying. I don't think it's a long-term structural bear market in the IT space. At the most, it could be a short to medium-term decline here. So, no threat to your long-term, very long-term core portfolio at all. On this educative and optimistic note, I'll bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment section, good, bad or ugly, I'm always looking forward to hearing from my viewers, and please help me reach out to fellow like-minded investors and traders by referring my video to your family and friends. I thank you for your patience, my friends, for watching this video and being with me here till we meet again in my next. I wish you have a very, very profitable week. Vijay Bambwani signing off for now. Bye-bye.